Good morning. So this morning we are joined by John Curtis for our Macroeconomics in the Mountains webinar today. John is the Head of Investment Research and Chair of the Investment Committee at Skybound Wealth Management. John Maynard Keynes, famously said that successful investing is anticipating the anticipation of others. Now, himself, John Maynard Keynes, was quite a successful investor, which can't always be said for all economists. So I'm sure you know the story of Irving Fisher, who himself had a lot of investments leading up to the financial crisis of 1929, and made the prediction 9 days before the great stock market crash that markets had reached what appeared to be a permanently high plateau prior to the Great Depression shortly after. As an economist, I struggle with this idea that economic fundamentals are not important. So I guess my initial question for you, John, is to what extent is investing and successful investing about psychology, about anticipating the anticipation of others, and to what extent is it about considering economic fundamentals, whether that's interest rates, inflation expectations, geographical imbalances, and across balance of payments and so forth?
So there's quite a few parts to that question. So I'll try and answer one by one. But on your point about how important is psychology in investing, massively, in a word. For me, it's actually the most important aspect. You can be the smartest guy with qualifications coming out of your ears, access to the best resources, Bloomberg terminals, teams of analysts. You'll be the most experienced investor. But if you can't keep calm in a crisis, stick to the game plan, it's that expression, isn't it? If you can stay calm while everyone else is losing their heads, the world is yours. Well, so I don't know if that's the actual expression, but you get my point. So
burning,
to be a successful investor it really is about what's going on in between your ears, as much as having the resources and having the knowledge about what to invest in, etc., etc. Now, for me, I take perhaps a less top-down macroeconomic view when I'm investing than, I suppose, the average investor. Now, a lot of our clients will quite often say to me when things are actually happening, what are you doing about it? How are you responding to this event that's going on right now? And they're quite surprised when I say really nothing. Even if I wanted to respond to that event, given the event is happening now and markets are not a reflection of the here and now. Markets are, of course, a reflection of people's expectations of the future.
Yes.
So if you're only reacting to what's happening now, you're probably not even one step behind, you're 2 or 3 steps behind, because let's face it, most of the investing environment is actually institutional investors. It's your sovereign wealth funds, pension funds, insurance companies, etc., etc. They've probably got access to all the information that's happening, now. They've probably already had it for a few days before you, weeks, maybe even months. So for the everyday investor, that's reacting to things that they're reading on the news. For me, I'll stick my neck out and say it's folly, really, because it's like a dog chasing its tail. You're always one step behind where really you need to be. So in order to take advantage of things happening in the markets, and this is the reason I believe it's very, very difficult, if not impossible, to achieve consistently over the long term. Of course, you make enough predictions, you'll get some right. Even a stop clock is right twice a day. But in order to benefit, you've got to make the right prediction, first of all. Then you've got to correctly predict how the market's going to react, because, as we know, markets and economies are not the same thing. Often the markets react in a way that goes against consensus. So prediction, the economic prediction right, the market reaction right. You've got to get your time right, of course, because if you're too early, you may not benefit. If you're too late, you've missed the boat. And then a point you alluded to earlier is, as well as sort of having all those pieces in the puzzle, if you're simply just going along with a consensus view, it's actually, so even if you've got everything right, your timing spot on, if everyone else has got that view as well, and everyone else is doing it at exactly the same time as you are, then really there's little to no benefit for you. In order for you as an investor to benefit, you either have to be early, so be ahead of everyone else, or your view has to be right and against the consensus, so that you're taking the opposite side of the trade, and those trades are based on the incorrect assumptions or predictions. So there's lots and lots of pieces of the puzzle. There's lots and lots that you need to get right. So my personal approach, although I don't completely ignore what's going on in the economy, I'm certainly not one, and this is through both personal experience and also the experience of watching and monitoring the careers of very, very successful fund managers and portfolio managers, some of whom have generated a lot of success, both for themselves and the clients who are making big macroeconomic calls. But then if you actually track their career, you'll find that the newsworthy correct call that they made was followed then by a series of mediocre performance, incorrect calls.
Right. Yes.
And that's not really something I want to expose my clients to. Me making a prediction about something and ultimately getting it wrong, or if I get it wrong, the markets have another idea, or I get my timing wrong. For me, the best thing to do is to stick to the time-tested fundamentals of investing, and that's really, it's not rocket science. It's things like diversification, having a handle on costs, taking a long-term view rather than a short-term one, and keeping a cool head and not hitting the big red sell button when things are crashing all around you, and having the discipline to stick to your game plan. Part of that involves, from my position, reassuring clients that actually sometimes the best thing to do is actually nothing, and that markets and economies will do their thing. But over the long term, and we're not just talking generations, we're not even talking decades, we're not even talking years, we're talking generations. Markets have, and we believe as market optimists will continue to do so, obviously not in a straight line. So for us, it really is that it's a very overused term, I know, but I believe in it. Time in the market rather than trying to time the market, which is one of the things that macroeconomic forecasters, almost by necessity, have to attempt to do.
Yes. Yeah. There's a couple of things there, because for me, an interesting one is this, the temporal aspect of investing, being the initial investment choice that you make at the beginning, and then your behavior subsequent to that. So I understand, once you are invested, once you are, vulnerable to what is happening in the markets, you are exposed to the markets in that sense. It makes sense to focus on those psychological aspects of discipline, of temperament, and not being too hasty. But at the beginning, when you are making those initial decisions around what to invest in, how much are those decisions based on, as you say, diversification, asset allocation, that type of stuff, and to what extent are they also with one eye on things like interest rates, on correlations between different asset classes, these sort of those type of economic analyses?
So, of course, things like inflation, interest rates, they do have an impact. They tend to have more of an impact, I find, in the short term than in the long term. And I'm talking long term. And the long term is where we base our investment decisions on. Now, I'm not just going to stick my head in the sand and put my fingers in my ears, cover my eyes up, and just say I'm going to completely ignore what's going on in the economy. What I'm going to do instead is, rather than say I believe over the next period X is going to happen with interest rates or inflation, and then tilt my portfolio into assets I believe are going to benefit from that particular environment, my stance is to consider the different outcomes. So what could happen? So what could happen if inflation goes up, down, or stays as it is? What could happen to interest rates if they go up, down, or sideways? And then to incorporate all the possibilities into the portfolio, so that we've always got something in the portfolio that's working in any given environment. And by default, that means there'll always be parts of the portfolio that will not be working because they're not in there to benefit from the environment at any given time. But for me, that's true diversification. You're not always trying to create a portfolio that's always firing on all cylinders at all times, because it's very, very difficult to then shift your portfolio into the changing of the winds at the right time. So what that means is we will always have a consideration of the macroeconomic environment, as I said, but for us, it's about what are the possibilities in outcomes rather than actually trying to forecast the outcomes.
I understand. I just another. I guess it's one of those what you would call a hot topic, John, which has been extremely popular, particularly over the last 6 months and really over the last 6 years, is cryptocurrency, Bitcoin, Ethereum, all these other variants. Now, we saw recently in the last few days with Tesla announcing that it had a slightly different view on Bitcoin relative to what it had a few months ago, and the price dropped pretty much 10% in a very short space of time. Now, Bitcoin, it seems to me, is an example of a type of asset, a type of investment, if you can call it that, where psychological factors play a big, big role. The success of Bitcoin, to a large extent, to me, appears as if everyone in the market or retail investors expect the price to go up, so they buy in, which itself causes the self-fulfilling prophecy and so forth. The difficulty with that bubble behavior is then what happens when it pops. The question then is it going to pop, and when? Now, obviously, predictions, that's not what we're here for, as it were. But I guess just understanding from your perspective, these type of things like Bitcoin, do you consider them investing vehicles? Do you consider them investing assets, or are they a different type of speculative investment altogether?
From my point of view, Bitcoin can be called an investment in the sense that people buy it for investment purposes. I personally don't consider it an investment, though. For me, an investment has sort of fundamentals to it, which include things like the having fundamental drivers of the investments that can be analysed, that has a long history for you to track to see how it's performed over time, and something that you can actually look under the bonnet and study and have conviction or not in those fundamental drivers behind it. Whereas things like Bitcoin and cryptocurrencies in general have very few of those characteristics. So really, I would argue, and I know some people will disagree with me, really, for me, the fundamental driver of Bitcoin is pure speculation. It's not backed by anything. It's only worth something because people think it's worth something. I mean, arguably, that's any currency, any fiat currency.
Sure, exactly. Which is the argument given by the people who who support cryptocurrency. Yeah. They say, well, when you have central banks around the world through quantitative easing significantly increasing the money supply, which has led to depreciations in the value of that currency, what is so different about Bitcoin? It's a way, well, and there's research as well showing that Bitcoin has certain hedge properties. It acts as a hedge when other investments are going down, and we've seen that really in the last kind of couple of years as well. So other people argue that there is something a little bit more fundamental about Bitcoin beyond just psychological speculation around the expectation and anticipation of others.
They do. I personally disagree with them, but I mean, yes, you could say that it has a lot of similarities with fiat currencies. However, we don't invest in currencies. We don't think that currencies are really investments either. Again, it's just speculating on the whims of the currency markets. So the thing about, let's compare Bitcoin and cryptocurrencies in general to the big traditional asset classes. So equities. What is an equity? An equity represents an actual share, an actual slice of ownership in a company. So you have entitlement to a portion of that company's future profits, or in the form of dividends. You have a claim in the event if the company was to go pop, for example, but had assets that were worth something, you have a claim on those, albeit after all the creditors and debtors normally. Let's have a look at bonds, for example. So a bond that offers you an entitlement to your 6-monthly coupon or whatever it is, and your money back at the end of it. With Bitcoin, you don't have a claim on anything. You have a claim on Bitcoin, which, as I said, has no fundamental value, no fundamental worth, only what other people think it's worth. Whereas with a company, even if you have an unloved company, which are these, what you call the so-called value stocks. So even if the share prices are tanking, those companies still have some value. A bond, of course, it can default, still will always have some value. Whereas cryptocurrencies, in theory, can go to zero. I'm always reminded of 2018. Now, of course, there's that expression, history never repeats itself, but it often rhymes. And again, I'm not forecasting this to happen, but I think with something like cryptocurrency, where there is a lot of fear of missing out, so-called FOMO, greed, envy. You've seen your friends making big bucks, and you want to slice the action. So this all happened exactly the same scenario in 2017. And actually, 2017 was more extreme. So the price gains of Bitcoin, for example, in 2017 were even higher than we're seeing now. But then what happened in 2018, Bitcoin then proceeded to lose over 80% of its value. It had 6 months out of 12 where it suffered double-digit losses in a month. 2 of those months lost over 30%. And again, I'm not predicting any of these things are going to happen, but it just goes to show you how volatile these things can be. And the reason they're so volatile is because, in my view, and again, I know a lot of people disagree, that's what happens when you have an asset class backed by speculation and nothing more. It doesn't have anything real under the bonnet.
Yeah. Good. John, thank you for your time this morning. I think, just finishing this off, I'm glad that you agree that fundamentals are important. Whether they are fundamentals behind the asset itself, whether that's a share or whatever that is, or whether that's maybe a broader fundamental in the macroeconomy, correlations and so forth, which, as a macroeconomist, I like to think there's still some value in macroeconomics. So I think, we've covered a couple of interesting issues today, and I'm sure there's plenty more to discuss in the future. John, thanks very much.